Exciting topic in as far as planning your financial future. Financial planning can be a little bit boring, so I'm going to try to lighten it up. I did have somebody give me a joke earlier, so we'll start off with that. What is it, Lady Gaga? How do you wake Lady Gaga up? Poker face. Okay. You got better, chime in. Okay, we're moving on. All right. So we're going to talk about financial planning. I do have pieces of paper laying right there on the table. So if you're here and you want to grab a pen and paper to follow along and put your own numbers down, that's great. If you want to just do it and you do math in your head, you can too. If you're following along at home, thank you so much. And you can do the same thing. Okay, here's what we're going to talk about. Standard disclaimer, everything that I tell you is using the knowledge I have as a CFP to talk about financial planning, which is kind of the wheelhouse. But if I talk about individual investments, I don't know your particular situation. So you have to do your own due diligence before you invest in anything that I talk about. Okay, why does financial planning matter? Let's start at birth, right? It doesn't for a while, right? You live at home. Hopefully, you had a nice, safe, healthy home environment, and you don't have a care in the world about anything until somewhere in the like early teens or so. You start giving a crap about, oh, I'm supposed to like not spend every dime that somebody gives me for Christmas money, that sort of thing. So you kind of ease into it as a kid. And I will say for your habits, is most of the people in the room are not teenagers. I will say is that your habits are kind of based, and already formed when you're like 6 or 7 years old. So somebody gives you $1 and you're either going to save it right in the piggy bank or you're going to go spend it. Right. So those habit patterns that you have as a young person often parlay into adulthood, which can be, if you're an oversaver, you can be a miser and not live much of a life. And all you do is sit back and count your money. I enjoy that activity myself. So I have to kind of get myself to spend money sometimes, or you spend everything you ever make along the way, and then you're kind of just this broke person all the way along. So this is kind of why it matters. Is at some point in time we call it adulting, which might be a made up word, but it's when you look in the mirror and you go, I should probably figure this out. So that's what we're going to talk about today. We're also going to talk about the other side of it, is if you have a bunch of money, kind of thinking about, well, what am I going to do with this money? Say if I'm 70 and I'm sitting on a couple mil, well, okay, what I should probably do something this instead of just giving it to the good for nothing kids, which we have one of those in the room. See, Smirk, so she's listening. Okay, that's good. That's half the battle, listening. Okay, so where you stand on your balance sheet, this is, you see the household example. So you have assets in your life. So that's, if you want to play along and you want to write things down, you can think of your house as if you own a house, that is an asset. You can put your home equity down. So you could either do the math of my house is worth 700,000 and I owe 400,000, so that's 300,000. I generally just put the 300,000 and I put that in the asset column. You can have investments. So if you have a 401k or IRAs out there and you kind of think, okay, approximately all that added together is so many hundred thousands of dollars. If you have that, that's good, or millions, or $12, right? If you just got started, that sort of thing. And then your liabilities are anytime you owe somebody any money. So it might be student loans; those are still a thing floating around. Almost everybody almost got off the hook there for a while, but nope, you have to pay those, which I'm happy about. But if you have those, that's a liability. If you have a mortgage, that's a liability. If you have a HELOC, a home equity line of credit, that is also a liability. And if you have credit card debt, so everybody knows credit card debt is kind of the silent killer of wealth, right? Because you're around that 18 to 20% type of interest that you're having to pay on those things. So those are really bad. But you can kind of schedule those out on your piece of paper, and you can kind of see where you stand. The assets are pluses and the liabilities are minuses, and hopefully, when you add them all up, you have something in the plus column. Otherwise, you really do need to take a hard look at the financial planning process. Okay, I will say this. So the first thing it starts is with your budget. So, and for most people in the room, you're kind of beyond the budget point, right? Budgets are more like when some of our younger folks, get out of college, if that's their track, they go get their job, they're making X dollars, right? And then they have to subtract out their rent payment, or if they're living at home for free, that's a zero. It's not a bad move. Or your parents may charge you rent. I don't know. We shall see. But if that's kind of the 20 something, right? Is like, I've got this money coming in, and then I need to have a food budget, I have an entertainment budget, a beer budget, whatever your budget is. a clothing budget, right? So you subtract all that out, and you can go into plenty of budget planners online for something like this. Most people in the room and most people probably listening or on are either a little too wealthy to budget or a little too old to budget because you kind of don't need to. But you do want to have, kind of those general expenses in mind. And we'll talk about it, just a few of those. Okay. So you want to be aware of your spending. And that's really the only thing you kind of have control of your income. But if you get a traditional job, your income's kind of like set. So then you have to choose to live below that income to be able to build wealth. If you live above the income, then you're broke, right? And it doesn't matter what the income is. We've seen that, like the football player example, a couple $1 million contract. How could this person really literally end up broke? I don't know. Ask Mike Tyson, because he was kind of like the champion of that. MC Hammer, I think, went down that road. I think Bruno Mars is performing for free at the MGM Grand for like the next 70 years to pay off his gambling debts. So I've heard. It's not slander, it's a rumor. So the don't sue me. Right, couldn't sue me anyway. The but you do want to take a look at living below your means is the point of all that. When you are just buying a house, I think 30s and 40s, you generally, and you'll see on the slide in the red, you spend about a third of your income on where you live. The good news is if you buy, that's an asset that's going to appreciate over time. And those of us who were very fortunate enough to buy a house in the Austin area 10 plus years ago, all literally have about an extra $1 million around because that's how much this area is appreciated. Are we all geniuses for doing that? Well, yeah, but we didn't know it at the time, right? We're just kind of buying a, yeah, well, there, divorces can divide things in half. That's correct. We don't talk about the financial planning for divorce, but I do, sidebar, I do sometimes get asked, like, what's the key to building wealth? And the first thing, that it's a little bit funny, but it's kind of the get married exactly once, right? One time. That will make the math is great. Um, if you, I call it the airline pilot model, because a lot of my buddies went from the Air Force off to the airlines, and it's an interesting lifestyle where you're gone a lot, and sometimes you end up with two families or three. This is, it's a professional decision, I guess. But yeah, literally, if you look at the airline pilot lifestyle, you'd end up with like three spouses along the way. So by the time you're making captain's pay, it's a nice, $270,000 check. You get like 60K of it, right? Because they're going to everybody else. So you're doing your society a solid at that point, to provide all that money, but you're not seeing it. So try, go for the once thing. Life happens. Run it back, run it back again. Whatever. You got to do what you got to do. But back to this. This is kind of a sample budget. So you've got your. The point of this slide is to say you're going to spend like a third of it on your house on living, and then you're going to spend half of it on other stuff, and then you want to have a savings rate. So back when I was young and kind of got started a million years ago, generally I was taught like 10% was like a good savings rate. Like you make, 50,000, you save 5,000 a year and you're good, right? You'll be fine. It's more along the lines of 15% now, or even 20%, because I don't know if you have noticed, things have gotten a lot more expensive lately. So, and I don't think that's a real temporary thing that we're going through. If you've, follow along, we like Bitcoin. So, often you heard folks say like money printer going brr, right? Like it's printing out money all the time. It was terrible. But the point is, I think we're going to print a lot more money. We'll probably spend more than we actually have as a government for the foreseeable future. Our two younger folks can figure it out. Obviously, we have all failed them. But yeah, I think that's going to happen. So their savings rate, the point is being the 15 to at least 20%. And that does include your 401k at work and IRAs, plus money that you want to build up in the bank. And why do you want to build up money in the bank when you're in your 20s? Anybody? Compound interest. I like that. But to buy what? Generally, that first house. The problem is where we could get there at 10, 15%, they're going to have a lot harder time getting there because the house prices have kind of run away. So the parents in the crowd, which is a lot of people, yeah, expect to help out. Okay, if you're a calculator type person because your pen and paper have failed you, or if you lost interest already, because I don't see any aggressive writing, but that's okay. That just means you're really tuned into the speech, and that's fantastic. The right back out of the pocket, I like it. You can go online. There's a million of these. We have one hanging on the Ankerstar Wealth. .com/calculators for you to go on there and discover several calculators of which you can go down the rabbit hole of online calculations. You can build it in Excel if you've had a little bit of Excel training. But the point is, you can go in here and make all your assumptions and then kind of see that, I think the joke on TikTok is, congrats, I found out I can retire at age 77 as long as I only live for 11 minutes. Um, those sorts of jokes. But yeah, you can get on here and take a look at this. But ultimately, if you are still working, one of the questions you might have is, when can I retire? Or if I choose to retire, at a particular age, what's my financial situation going to look like? So those are available, and of course, if you're working with an advisor, we have a very advanced program to help break all that down for you. Okay. This is like, telling you should have gone back and worked out harder so you could be in the NFL kind of advice. But yeah, you should have started earlier. Um, congrats. Congrats if you did, right? I was very fortunate. My parents kind of insisted on it when I was 16. Um, so they told me, it's like, hey, you need to get a job because you need to put into an IRA. And I'm like, point of order. I was an only child, so I had to face the board. I was like, hey, you said that if I get good grades, I don't have to work. And they're like, yeah. And I'm like, I got good grades. Look. And they said, you got to work. And so I cleaned toilets at a golf course, which was not awesome. But I did get to fund, $2,000 was the max at the time for dinosaurs like me when the IRA started. So I funded that. And obviously that's gone up a little bit since then. So starting early is kind of the key. Why do I bring it up here today? You probably have younger folks in your life. So if you learn anything tonight and you want to go home and say, hey, this is something you need to be doing, what's a 20 something going to be super receptive about, getting a salary and then not spending it? Probably not so excited, but give it your best shot. It's like anything else. Nobody expects perfection out of parenting. You just try to say, hey, this is kind of what you need to be doing, whether I can articulate why or not. You're going to thank yourself later. So, and you can flash back on your own experiences. And I like to say mileage will vary, right? On what you did personally to where you are now. But obviously, 10 years makes all the difference in the world. The examples there, you can read through that, but about $500,000 difference on whether you start at 25 or 35. If you have earned income earlier on and you get your kids to start in their teens, much better. Okay, tracking your progress towards your goals. This is kind of now thinking not budgeting, but you want to buy a house or a second home or a yacht, which is not a great investment. Um, but or fancy cars, also not listed on here because they're depreciating assets. But if you want to build wealth for whatever reason, then these are the things that you're going to own. And you're going to think about, how aggressive do I need to be to raise the amount of money that I want to have? So you kind of work backwards. So if you were thinking, if you have your pen and paper out, that in retirement, I want to be able to spend like 150,000 a year. You put 150,000 at the top, and then you subtract out your Social Security, which if you've worked most of your years, you may know the max annual Social Security right now. If you maxed it out, what you would get, about 49,000. You can do 50,000 if you want, because it makes the math easier. Subtract that off. Everybody in here, except for maybe two of us, is going to get the promised Social Security. Past that, I don't know what's going to be left over. Y'all figured out. So you can have that. If you have a pension, you would subtract out your pension there as well. And then the rest you need to make that money out of your portfolio. So if that gap is $50,000, you can think kind of reverse engineer. If you had $1 million and you invested at 5%, so the $1 million is the cow, 5% is the milk. You don't want to touch the cow. You want to live off the milk. Then that would be 50,000 coming into your life. So add that to the bottom. And if you're like, well, I don't have a million, all I have is like 400,000. Well, 400,000 will kick off about 20,000 a year, and you subtract everything out, and there's a big delta there. Well, that means you're going to have to reduce your lifestyle because you don't have the money to pay for all the things that you used to, or sell your home. So that's another way folks can get kind of bailed out from the saving and investing thing, is if you have the foresight to move to a very popular area and you end up with $1 million in equity in your house, you sell that darn thing and downsize and capitalize on the equity from your house. But either way, for every million that you can come up with, you want 50,000, kicks off 50,000 of milk, if you use that analogy. So if you're sitting on a couple million, 100,000 probably get you where you want to be. So other assets do have the Bitcoin Easter egg there, if you happen to notice. So You can, if you saw the news today, Trump's allowing you to put crypto into your 401ks. So obviously we're pro Bitcoin here, but I also am allowed to make the joke. If it goes to zero now, oh shit, shucks, right? Because I mean, it's being widespread adoption, going up in value, and now it's in people's retirement plans. So I'm confident it's here to stay. If you're a skeptic, that's fine. Argue with me later. But right now, I got the mic. So consider. Fixed income has been a very challenging space. Bonds have been only kicking off like 4 or 5%. If you go back a few years ago, interest rates were zero. You couldn't even get a CD that was worth anything. Um, but equities is where it's at, and some Bitcoin. Okay, how to invest? It's not a teaching you how to invest, but if you're talking to your kids after this, there is an investing philosophy called buy the SPY and die, which is the only thing you ever do is buy the S&P 500, which are 500 most common, not common, but you have to qualify stocks talked about on TV all the time. It's a roller coaster for sure. So you got to stay strapped in or not look, either one. Both of those are valid strategies. But if you want to make any attempt to be active with your investing, you simply buy the S&P 500. You start, you dollar cost average in on a monthly basis or annual basis, either one. You pile it all into the best companies the U.S. has to offer, and at the end you're going to have a nice pile of money. It's undefeated. It's always gone higher. And I think that will continue. And people are like, well, it can't continue forever, right? I'm like, well, yes, it can, because it's survival of the fittest. So the weak companies get killed off and they aren't there anymore, and the bigger companies grow. So it literally can go up forever. So that's how that works. 10 to 12%. That'll get you done for most everybody for as far as their interest rate. So if you want to do more advanced stuff than that, then we can talk at a later date. Okay, financial planning example. So if you're working with an advisor, all of them have financial planning softwares that they can sit down um, and walk you through. Generally, you're talking anywhere between 70 pages to like 140 pages. If you have trouble sleeping at night, this is great reading material to try to tackle at about 10 p.m. You won't get very far. What I've found, or when I talk to my clients, is basically I go, here's an electronic 150 pages. I go, here are the 7 pages that matter, and literally go to those and we talk to those. If somebody wants to like go all in because this is like their favorite thing to do, and those people exist, I don't have many of those in my friend group. But if somebody wants all of it, you can read all of it. So financial plans are a guide. It kind of gives you that one-time look to get an idea of where you are. When are they really helpful? Closing on retirement, right? If you're 50 something and you want to retire around 53 or so, it's probably time to start looking at the numbers, right? To see what that would look like. Because generally, once you leave the workforce, it's kind of tough to go back. Not not because you don't want a job or you're unhireable. It's just like you don't feel like it. Office space. I don't think I'm going back tomorrow. That sort of thing. And once you stop going to meetings, if your boss asks you to go to a meeting like me, completely unemployable because yeah, I don't go to meetings anymore unless I'm calling the meeting, right? So here's some slide shots or screenshots from the financial plan. I put it in small font, so you have to squint and pay really attention to it. But basically, the top there's the needs, so it's kind of figuring out where your money's going. Need is retirement income in retirement to get by, as well as healthcare. If you don't save anything for healthcare, uh, you're you're taking some risks. So you might end up on the state's healthcare. Think Medicaid, where you're really getting the bare minimum. So you want to save some money there, so don't spend all your money going into retirement. There's also some wants. We generally, if you think of phases of retirement, there's go, slow go, and no go. So generally, if you can retire in your late 50s, early 60s, you're in go phase where you and your partner, if you have one, hit the road and you travel all around. So I will in here for like travel, I will generally do like a 10-year period where we have a budget for that, right? You put a budget out so you don't argue about it with, you just spend the budget and that's it. And then it's built in. So you have the go phase, and then slow go is we've got the money to go, but we really don't feel like going. And then the no go phase is get mad, watch TV, Fox News, CNN, get mad at the other politicians, get angry at the world, tell people to get off your lawn, all that stuff. Some of you may have started early with the get off my lawn, but generally that's reserved for later on. That is a very cheap portion of your life. So what you don't want to do is save like a miser through the go phase and not go. And then by the time you're like, okay, we've got our 7 million, now we can afford to take a trip. Like, okay. And then you go to like 2 or 3 trips and you're like, well, screw this. I don't feel like going because my knees hurt or my back hurts. So you want to really kind of manage that. So you can build it in and then model it out. And speaking of modeling, a lot of people like to upgrade their homes. So good idea, right? If your kitchen's making you mad because it's from 20 years ago, then yeah, budget that out, right? So you can put placeholders in here. They have $30,000 for renovating their apartment. That won't get you very far. We'll say that. Financial plans also do investment recommendations. It's got all, I won't go into it, but it does give the advisor some ideas of some moves that you should move around. We look at that with a grain of salt and we largely use our own models anyway. Social Security, we talked about it earlier. The financial plan will walk you through, do I claim at 62? Because I don't trust that darn government, then I better take every dollar I can because it's going to zero. Or the I want to wait till age 70 because I want to get the maximum amount that I can. But you don't know when you're going to pass away. So if you wait till 70 and you pass away at 71, well, you know, not good math. Should have claimed at 62, but you don't know that, right? So unless there's some health issue where nobody makes it to 75, then I would claim earlier. Just those are your genes. Can we say that? So if you have good genes and everybody in your house lives till 100, then yeah, I would wait to claim, right? But you don't know that, right? So the government kind of doesn't care. Around 82 is about the break-even point. If you think you're going to live longer than that, then wait to claim. If that's like nope, that's not going to happen, claim early. Or when you retire, when you stop working, just claim at that point. That's a pretty easy math to do. The one thing that people don't realize, if you retire at 65 and you don't plan on claiming till 67 or 70, that is a gap period. The money that you're living off there, you need that comes out of your portfolio, right? Because the Social Security hasn't kicked in yet. And if you've maxed out and you happen to be married at the time, one of you may get a full Social Security, and the other person generally gets half of that. So that's like 75,000 coming in if you were, had a $150,000 job for large portion of your adult years. But a financial plan can help you do a little slider and go, okay, here's what life's going to look like based off of that. It also gives you cool graphs. So in this one on the top side, you see that orange thing is the renovation of the apartment. And then you can't even see the yellow because the travel budget's so small in relation. Then it shows you in retirement. Don't forget about that inflation thing. So if you think, okay, I need 120,000 in retirement, well, this runs the math that if you run forward to 20 years, that's like 240,000 now because inflation's a bear. And then it has a goal timeline that also shows you down there how it works out time wise. Okay, your net worth summary, which I know you've all actually done on paper right now. So if you wanted to do colors, you would use red, green, red, and blue for the difference. I didn't bring the crayons out, so you'll have to imagine that. But that's what you're kind of determining is what is your net worth. And then your house is a little bit different, right? Because it doesn't generate income. So you kind of look at the portfolio and how much can that generate. And then if that's not enough, the house sale may come into play, but it'll draw all that out for you. Okay, risk assessment we won't talk to. There's all kinds of different things there. And then this will, if you're using a full financial planning software, it will literally break down based on several assumptions, right? Of exactly where you're going to, um, you put in where you want to retire. So this person retires and 65, and then Social Security kicks in 2 years later at 67. And then it shows that, okay, they have a bunch of money still at the end of the game, which it calls end of plan, which means pass away. Don't forget there are age differences in relationships. So, and not like the uh, the Patriots guy, Belichick, and not generally that's not the difference. We're talking like sometimes 3 years, 5 years, 10 years. We don't realize that means if you're the younger one, you're probably alone or remarrying or you do you, but later on in life. So that sometimes can work out to where you're alone later in life. And with Social Security, when one spouse passes, you get the better of the two Social Securities, right? So you don't get the full amount you were having when somebody passes away. And if somebody has a traditional pension, you also that may not have a survivor benefit plan. So things can change if somebody passes away early. Okay, and last, tax optimization, which I threw that in there to scare you to think there was definitely a whole bunch of more slides, but there are not. But yes, you want to move through life smartly, but topic for another day. Here's your advisors. I'm opening up to questions now or jokes if you have one that you want to tell. And yeah, hit me. I'll repeat it for the crowd at home. Okay, I'll ask one. Um, when should uh, when should your kids start investing? Um, if you can, when they start working, you can, if you're sitting there at 3 million plus, then you're probably in a situation where you can, there, there's no retirement loans, but there are student loans, right? So you don't want to dork up too much, but you can start giving your kids up to 19,000 a year if you want to start moving your money downhill and into your kids' hands. Obviously, that can make a big difference on whether they view that as money that they can now go buy stuff with, or whether that's investing money. But if you convince them that this is the investing thing, then that's a good way to do it. And any number between like $100 and 19,000. That just happens to be the math. Also, don't forget, if you are in your 50s or 60s in here and your parents, you're fortunate to have your parents still around. That's a pretty good source of money too. You can leverage them and say, "Hey, I have an idea." Instead of more La La Loopsy dolls for Christmas, how about like 5 grand in money? It's like, but we're gonna give them 500 of it, and then we're going to invest the rest in their accounts. And it's like, oh, grandparents love investing, right? So pretty easy sell. So those are some strategies for you. Okay. By now, somebody's got to have a question. Okay, I like that. That was like 7 questions wrapped in one. Close enough to the phone, so I'll go at them randomly. Um, Generally, when somebody's born, if you're in a situation where you can start handing money down to a grandchild or your own child or whatever, seems like we're all broke when we first have kids. So it's like I'm not funding that stupid college thing. But if you can afford that, or at least kind of start it, you're thinking college savings. So for infants, that sort of thing. And there are high limits on that. So you can dump a ton of money in that if you want. You could argue whether you should, but you could. So that's one thing. If you open up an account for a child that's below age 18 here in Texas, different states have different rules, then you will be the custodian of that account. So good news in the fact that you put 10,000 in because you felt generous that day. Your son or daughter cannot go in there and withdraw that, right? Because you're the custodian, so it's their money legally. You can't take it and buy stuff with it either because you gave it to them. But they can't reach in and touch it until the age of 21. If they're over 18 when they start, then they're adults, and you could, the money you put in there could be gone, the next day if you want, because they could just log in and take it. And even if they're working with an advisor, I can't stop them. I can only advise them like, oh, I don't think you want to do that. And they'll be like, and I'm like, play the long game, dude, dudette. If they just gave you 10 grand and you're like 18, you're probably getting more if unless you blow it. So I think play the long game. Um, so why start? One of the questions was why wait till they start working? If they're working, if they have W-2 income, then you can put it into a retirement account. Generally, it'll be a Roth IRA at a young age. And then that way, there's two reasons. It grows tax free, but also they can't touch it without a big penalty. So even if they're inclined to reach in and grab it when they're 20 something, they're going to go, ooh, I don't really want to pay the penalty because there goes 10% off the top. Some don't care, do it anyway. But there's a little kind of fence there. When the question was about 25 and 35, those fences, now you're thinking more of trust scenarios where you set up a trust and say, hey, I'm giving you this money now, but you don't get it all when you're 21. You get, 10% of it when you're 25, and then 25% of it when you're 30, and half of it at 35, and the rest at 40. Generally, those are larger numbers. Start dropping like millions. Some of you don't think about it, but if you're sitting on a couple $1,000,000 and you drive home and you get that car accident scenario where all of a sudden both of you are not around, and now in our case, I have a 20-year-old and an 18-year-old that's sitting on pretty significant amount of cash. Where now my oldest leaves for Alabama on Sunday. If she heard that news on Sunday, she could be like, turn right around, like I don't have to go to school anymore, or have a job, right? Because a lot of people think those numbers are like, ooh, that's all the money I will ever need. Have fun with that. But yeah, so that's where you might think of a trust. Most people think of wills, just make sure it passes down. Trust puts an additional layer in there of protection from themselves, mostly for not blowing through the money. So good question. Questions? Correct. Did I get all of them? I think actually there's one more in there, but I can't remember what it was. There you go. So that can be confusing though. If they're already 18, they have their own account. If they're under 18, then it goes in a custodial account and they don't have access till they're 21. So, all right. Any other questions? All right. You guys have been off. Oh, we've got one. Go ahead. Mhm. Okay. The, the question is, if you do a Roth IRA, how do you pay for the taxes, right? So if it's coming out of your bank account, then you're going to pay money. You're going to pay the taxes out of other funds, and then the money you put in your Roth IRA is going to be that 7,000 if you're below 50, or 8,000 if you're older than 50. So the real art is if you're doing a conversion, which where you have a traditional IRA and you convert it, say it's 100,000, and you convert it to Roth, you will owe taxes on that conversion at whatever your tax rate is. It's better to not use money from the conversion and find some other money. So we can sit down and talk to your situation. But yeah, you want, if you're converting money, you want that all into the Roth. So when you think when you're 70, um, if I have, what's worth more money? See if I can do math. $1 million Roth IRA or a $1.3 million traditional IRA. The $1 million in the Roth is likely worth more because you're going to get taxed on that traditional IRA as you draw it down. So to get everything into under a Roth hat is a really smart move. So good question. All right, any other questions? All right, you guys have been awesome. Thanks for watching at home. They did laugh at the appropriate times in here, so I like that. Good crowd. They all get invited back. So with that, we'll see you guys next time.